The boomers have all the money and they're net sellers. Like there isn't a rate that you can raise rates to convince a 70-year-old boomer to change their time preference, right? Like they're saying, I got 5 good years left, maybe 10. I don't give a shit if the Fed pays me 20. I want my money and I want to go to Italy.
Larry McDonald here with Luke Gromen. I'm really excited about this conversation. I've been a big fan of Luke's for a long time. And, we're going to get into, not just where the dollar is going, but what's the big secular trade for the next decade. Our next book is called When Markets Speak. It'll be out with Penguin in the next quarter. And our first book was a New York Times bestseller about the failure of Lehman Brothers. It's now published in 12 languages. And I'm very proud. It's a CFA Institute top 20 all time, A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers. Our new book connects the Lehman debacle with COVID and this new world that Luke is a spectacular skill set in analyzing where we are now and looking forward. And so I want to bring in Luke. Luke, one of the themes in my book, When Markets Speak, Penguin will be out next quarter, is really the multipolar world versus the unipolar world. And so in the book, I sat down with James Baker, I sat down with David Einhorn and different figures in the market and in politics. And it feels like, in terms of the dollar, everybody knows about this dollar bear thesis around, okay, we've used sanctions and we've used weapons over and over and over again, weapons that probably should be used once a decade are being used 5 or 6 times a decade. And we've built up a tremendous amount of adversaries in the world. In a unipolar world, it's really like from 1970, well, maybe we're like 75 to 2020 to some extent. The U.S. was really like the sole power in the world. I guess you'd have to say after the 80s. So after the fall of the Soviet Union, where we were really a unipolar world and where the United States was really a strong, pretty much the sole superpower. Now we have a situation where we've got China is strengthened, but also other emerging market countries because of the aggression with the sanctions and the U.S. Treasury. We've built up some adversaries. We're heading toward a multipolar world. Is that your view on it? And how do we look at that going forward in terms of investing?
I do think we're heading toward a multipolar world. I do think a big part of that driver has been the over-weaponization of the dollar and the dollar system through sanctions. But to me, at least as big a part, probably a bigger part, is a realpolitik / geological reality, which is as long as oil and critical commodities are only priced in dollars, we are now in a peak cheap oil world where we're not running out of oil, but the cheap stuff's gone. And so oil prices need to rise secularly on average over time. And as a result, that guarantees that dollar FX reserves will run out. And when they run out, as basically being spent down to buy energy, because energy gets more and more expensive every year and these emerging markets are growing, so they're using more and more energy every year, they then all are mathematically guaranteed of heading toward a late 90s Southeast Asia crisis, where you have to devalue your currency after you run out of reserves, you have an economic crisis, a political crisis. And so, to me, it's a combination of the over-weaponization of the dollar and the dollar system, which I agree 100%, but also this geological reality of peak cheap oil, where it is simply a matter of utmost national security for both the world's energy importing creditors of the United States, the Japans of the world, the Chinas of the world, the Europes of the world, and also the energy exporting creditors of the United States, the Russians, the Saudis, the Gulf, the GCC nations more broadly. They simply can't afford to store surpluses in treasuries whose value is guaranteed to fall against oil and other commodities over time in a peak cheap oil world, because it just means they are on a guaranteed highway to a global Southeast Asia crisis, which is simply not in their interest and something they're not going to abide. And so I think that's really been sort of a turbocharge alongside these over weaponization of the dollar over the last 10 years, as you've noted.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
So when you think about central planning, we have central planning in Beijing. And I often say the 10 most dangerous men in the world might be sitting there in a room in Beijing, because central planning is dangerous, right? But in some ways, we have central bank planning in the United States, right? So we've taken 5 million jobs out of the United States. We've decimated the Rust Belt. We now have a massive dependent class of human beings that, fathers wake up in the Midwest that 20, 30 years ago, their grandfather woke up and really was proud and represented the family. And now we have people that have been displaced by technology, by cheap labor overseas. The good news is we've raised the standard of living dramatically in the developing world. Young people in India today in a call center are making, maybe 10 to 100 times more than their great grandparents. And so haven't we created a new class of energy consumers? So we because we've raised the standard of living in India, raised the standard of living in Vietnam, but at the same time, if you look at the capital expenditure investment track from 2014, where we were, if we were on that same pace to today, we probably would have spent an extra $2 to $3 trillion on oil and gas and metals and all the things that we need for the world. Since 2014, the global population's up about 600 to 700 million human beings, okay? And so there's a billion people in India that don't have air conditioning. There's a billion people in China that don't have an automobile. Isn't this a recipe for a problem? Because like you said, those resources that we need, that the investments in uranium, in copper, in oil and gas, we need those investments to find those minerals and green metals and oil and gas. But we've raised the standard of living globally. This sets up a pretty toxic cocktail based on what you just told me, before about the balance of payments.
It does from multiple standpoints too, right? If you look at per capita oil consumption in India, it's 1/15 of the United States. In China, it's 1/5 the United States. China is already the biggest oil importer in the world. They surpassed us 4 or 5 years ago. And so I, from time to time, read about peak oil demand, and I laugh because, number one, human demand for energy is infinite. It's a question of price. If I could fly a G5 on vacation everywhere and take a helicopter everywhere I went, I would. And if energy was free, I would do that. So would everybody else on the planet. So it's a question of rationing infinite demand for energy with price. Historically, that's been done via the dollar, effectively, right? Oil was only priced in dollars. And so, again, here too, it ties back to that initial point where if the dollar strengthens too far against the Chinese yuan or against the Indian rupee, energy gets more and more expensive. They reduce their usage. By creating this gigantic middle class, so those two, like that I said, are 1/15 and 1/5, India and China, respectively, of per capita usage of oil in the U.S. or of the U.S. Excuse me. That's 35% of the world's population, and they have infinite demand for oil, just like every American does. They, people, and so they're. This is why I think the energy situation is a forcing factor to multipolar and to the de-dollarization of global commodity markets. Because if you're China, you can very clearly see how China has been working to set up the infrastructure to pay for energy in yuan. And people say, well, who wants to take yuan? We've seen, well, The Russians are taking yuan, Venezuelans are taking yuan, the Argentinians are not taking yuan. There's a lot of different commodity. The Australians are taking yuan, the Brazil. So that if you want to turbocharge per capita consumption of oil and other commodities, the single best way to do it is you start to form a middle class, and then you gain the ability to print your own currency for commodity imports. That's exactly what the United States did. Form a middle class after World War II, and then in 71, you can print dollars for oil, and guess what? Boom, our per capita oil consumption is still the biggest in the world for any non-oil producers. And the reason that is because we're the only nation up until just recently that could print our own currency for oil and other commodities. So we can see this happening. Middle class was formed by these trade deals in China in particular, increasingly in India. And now, both by strategy, in the case of China, they've been working on yuan, oil, and commodity purchases very methodically over the last, 10 to 15 years, and employing gold settlement mechanisms, it appears, to facilitate that. And now, more recently, the sanctioning of Russia has accelerated this paradoxically. I don't know that it was the intention, and people will frequently say, well, the Russians are only selling oil to the Indians in rupee or in yuan or because we sanctioned them. And who cares? Doesn't matter. Once you kind of go to that, you're probably not going back. And so the way to think about when you read increased share of Chinese oil purchases in yuan is China's per capita oil consumption is going to go from 1/5 to the United States to 1/4 to 1/3. And the capita is so big in China that as you go from 1/5 to 1/4, it has enormous implications for global oil demand, let alone if India goes from 1/15 to 1/10 to 1/5. And at the same time, what's happening in U.S. shale's peaking by virtue of some of these same sanctions where we implemented price controls in the United States with SPR. We dumped the SPR. That was a capping of oil. It was price controls. So they always work in the short term. They always end in tears in the long term. So this peak cheap oil dynamic, when overlaid with what's happening with shale because of U.S. sanctions last year, and more importantly with the strategic shift led by China, facilitated heavily by Russia initially, but it's now being more broadly supported to allow China to buy more of their commodities in yuan, is going to facilitate significant per capita increases in oil and other commodity consumption in China because they can print yuan for these commodities. And again, it's being facilitated through gold, which means I think is ultimately really good for gold, which is a whole separate discussion. But absolutely, it sets up a dynamic where it's really good for demand for oil. There's not a lot of increasing supply for oil. The marginal supply for oil has 90% of it's come from U.S. shale, which has been put under pressure by what the U.S. did last year with the SPR and with rate hikes. And then the final sort of, creme de la creme or piece de resistance of this whole crazy setup is the U.S. bond market and the Western sovereign bond market more broadly is so over-levered, they can't afford any kind of oil inflation. You get oil inflation going, the bond market in the West globally is going to revolt, and that then forces the whole world towards what Japan's been doing with yield curve control.
Yeah, so if you think of like normal commodity cycles of the last, 50 years, there always are the normal booms and busts because CFOs make poor investments, as many CFOs did in, say, the natural gas space in 2011, 12, 13, 14. Poor Aubrey McClendon, and a victim there, Chesapeake. And you've got these booms and busts where these companies make these tremendous investments in the uranium space. We've seen, a 10-year bear market with lower and lower highs, and now a new bull market. But when you have a normal commodity cycle, you have CFOs that make bad investments. Those CFOs get fired, and new CFOs today on the ground in the natural gas space, in the oil space, in the copper space, they're looking at their last 5 or 6 bosses that all got shot and fired, and they're making, much more conservative decisions around capital investments. And then you throw on top of that the global dynamic around ESG, the multipolar world. It's more difficult to make investments in some parts of the world politically. If you look at Chile and Peru, you've got about 40-50% of U.S. global copper production comes from certain parts of the world that have this political stress. So you've got the political stress, you've got the regulatory suppression from environmentalists and EFG, and then you have the normal commodity cycle of capital discipline into what you just described around a global dynamic of higher demand and higher energy consumption per capita. Doesn't this set up for and we're thinking about let's construct a portfolio of the next decade. The previous decade's portfolio was really designed around financial assets. So your FANG stocks, your growth stocks, your bonds, financial assets did well, and to the point where we almost have 20 trillion in the NASDAQ 100 today. I think it's about 18 trillion now versus a high of say 20 trillion in 2022. So it feels like the entire planet's wealth is still in financial assets. And meanwhile, you just set up a dynamic where the next 10 years, it looks to me like your BHP bulletins or your Chevrons could end up in the top 10 or top 5 market cap companies. So a transition into hard assets, a hard asset decade. How are you looking at that, financial assets versus hard assets, and investing over the next 10 years?
Absolutely. I think the 60-40 portfolio of the last 40 years that has just sort of been buy it and forget about it and go to the beach, I think that's dead. I think the 60% equities, I think, will still work. I think 40% bonds, I think you always want to have some short-term bonds for income. But when I lay out and consider everything we've just talked about, Larry, I don't know why you own long duration bonds at all in a portfolio. I don't know what especially when they're yielding below short duration bonds. If with an inverted yield curve, as an investor, not a trader, as one of my best relations on Wall Street calls, it's just blood sport. For what? I don't see the purpose. So I think we're in the we may not even be in the first inning. We may be in pregame batting practice for a shift where the 60-40 portfolio goes from 60% stocks, and that 60% alternates between growth and value over the course of, various mini cycles within that long cycle, to 60-40, 60% stocks, and it's I think within that, bonds are going to be a very tiny part. And I think they'll be mostly, shorter duration. And I think you have a vicious sector rotation within the 60 of equities of commodities, industrials, because we haven't even talked, on top of all of what we just talked about, a hugely bullish secular dynamic for commodities and industrials. We haven't even gotten to the U.S. is reshoring because the Defense Department is saying, hey, guys, we took this too far. We can't even make masks. We are running out of shells in Ukraine, and this is not even a full war against Russia. We would get, if we were in a real full war against Russia, we would run out of shells in days, as some defense officials are saying. So then you layer on the reshoring of the United States, which is going to take, as much as people say, all we need is the dollar. No, my wife's truck doesn't run on dollars. The trucks that will reshore U.S. factories, they don't run on dollars. They run on diesel. My wife's truck runs on gasoline, and they're built with commodities, not with dollars. And that's a dynamic that I think we're in very early innings. And I have described it to clients by saying, for this financialization that has gone into, over the last 40 years overall, but that's been turbocharged, like you just referenced, in terms of these financial assets, these tech assets, they have separated in the minds of policymakers and in the minds of a lot of investors, the dollar and commodities. They've come to think of them as the same thing. They haven't had to think about it. And they're going to start to realize that there's a difference. There's commodities and there's dollars, and they're not the same thing all the time. And what the real value is, right? Everyone thinks everyone knows the price of a barrel of oil, right? Today it's whatever, $76 or something. Not a lot of people understand the value of oil, which is 25,000 man hours of work per barrel times $20 per man hour. The value of a barrel of an oil is closer to $500,000. Now, of course, the world economy couldn't run at that, but there's a lot of room to run in terms of the price at 75 and the value at 500,000 for that price of oil to run and the price of other commodities to run as the dynamics we've discussed, including reshoring, force a reappraisal, re-rating of price somewhere closer to the direction of value. Obviously, we're not going to $500,000 a barrel, but $120, $150, $200, I don't see why not in this. I mean, I just don't see why not. And of course, that will spur more production, et cetera, because it's peak cheap oil. It's not peak oil, it's peak cheap oil. But that is what, if we want to grow to support the debt structure, we need those commodities. And to grow those commodity supplies, you need price. You need a price impulse. And that price impulse at current levels, to your point, is not there. They need to get those CFOs who've seen 5 previous bosses shot for capital misallocation. The prices need to rise enough to get those guys emboldened to say, you know what, I know the gun's at the back of my head, but I don't care. At $200 oil, $150 oil, I can sell this to the board. At, whatever, $8 copper, I can sell this to the board. I can sell this to investors, and I'm not going to get shot. And so I think you're exactly right. I think, to me, setting aside the wiggles, that is, in 10 years, I think we wake up and we see that top 10 list, and it's BHP, it's ExxonMobil, it sort of looks like the late 70s again.
Yeah, like 1980, people forget in 1980, after that kind of hard asset 12-year run from the 60s, and remember the 60s, one thing Neil Ferguson said to me on Real Vision right after COVID says, wars bring out sustained inflation. And so you had Vietnam War and the Korean War, and you've had that 1968 to 80 run for hard assets. And now we have COVID plus a war. And so, but in 1980, the composition of the S&P was 50% industrials, metals and materials, and oil and gas. So 50%. And now that component of industrials, metals, oil and gas, materials is like, I think it's probably less than 12% all in. And so the probability that composition of the S&P goes from 12%, not back to 50 possibly, but definitely back to 30, I think is high. One of the things I talked about in my first book, The Colossal Failure of Common Sense, about the collapse of Lehman, is the fiscal and monetary response to Lehman and the financial crisis was about $3.5 trillion of fiscal and monetary. But the response to COVID and the war in the Ukraine is upwards of fiscal and monetary. So all in fiscal, I think it's close to 9, the rest is monetary. So you're close to 14.3 trillion of fiscal and monetary. And one of the things I said in my book was, if you take $1 trillion and you put it in a box, right? Take $1 trillion, you put it in a box. It won't create inflation. And essentially after Lehman, that's what they did, where we had a crisis in the banking system. They needed to fix the banks. So they needed to have that little bit of a curve where you could fix the banks. The banks could borrow here, lend here. And over time, through trillions of dollars or $1 trillion plus dollars, they could repair their balance sheets. So if you had a $50 billion loss over time, and that's why if you look at the chart of Citigroup or any one of these stocks, you've had this huge drawdown in the financial crisis, but over time they've been able to make that money back. So that's one of the reasons why I think that we didn't have any inflation post Lehman. Really, we took $1 trillion, we put it in a box. We weren't injecting money into people's bank accounts. Now, here we are today, out of that 14.3 trillion of fiscal and monetary, we've deposited hundreds of billions of dollars in people's bank accounts, whether it be through COLA adjustments to inflation. Now 70 million Americans, 70 million, got a 9% pay raise this year. That's one of the reasons why the fiscal side is up, I think, 15% year over year this year. We're spending 15% more this year than we did last year. And so when you think about the interest on the debt, because of all this fiscal and monetary, if the Fed keeps rates here for 12 months, Luke, just they lecture us over and over again, higher for longer, higher for longer. If they really keep rates here for 12 months, a year from now, interest on the debt is not $1 trillion, but really like 1.3 trillion. Okay, and then that crowds out your defense spending and your all of your discretionary. And I noticed, you know what the worst performing equity sector right now is in the last 4 months? It's defense stocks. I mean, defense stocks are underperforming the S&P by since April by over 20%. Whether it be Lockheed or Raytheon or whatever. How do you see this dynamic where you've got the fiscal and the monetary response, and then that crowd out of certain spending next year, and how does that play out in Washington and with the budget?
It's a great point. And I would start by tying it back to the tail end of the prior discussion, which is in the late 70s, when Volcker did what he did, U.S. debt to GDP was 25 to 30%. It's 120 now and rising again. When Volcker did what he did, deficits were anywhere from 1 to 3% of GDP. Trailing 12 months, they're 8.5% and rising because of what the Fed's doing. So it is a very, very different dynamic. And what that all speaks to is, again, another overlay on top of, all right, we overlay the reshoring on top of all the bullish commodity, secularly bullish commodity and industrial stuff we talked about. But now you're in a Western sovereign debt position in particular that these sovereigns simply cannot afford to let rates do what they did in response to higher commodity prices. Mathematically, they will have to implement yield curve control because, like you said, 1.3 trillion a year from now, pro forma, if rates just stay here, that is 150%, almost 160% of the defense budget. Something I've said multiple times to people on Twitter. People say, well, until someone else demonstrates a military ability to take down the U.S., the way empires work and reserve currencies work is there's not a replacement. I said, empires are compounding interest is undefeated all time against empires. We're seeing it happen. So you're going to have inflation go up. So let's say they just stay here, $1.3 trillion, 150% of the defense budget. And so the question then becomes, there's really only three things they can cut. Right now, if you look at entitlements, all in, that's Medicare, Medicaid, Social Security, and Health and Human Services. So it's a broad category, but that is, this year it'll be about $3.1 trillion, which is almost 70% of tax receipts, almost 70%. Defense is another 20% of tax receipts. Okay, that gets us to 90% of tax receipts. Okay, now we look at Treasury spending. It's running over $1 trillion. Okay, that's another 25%. So you're at 115% of tax receipts. And tax receipts are highly dependent on the margin on U.S. stocks going up. So if stocks go up, receipts go up. If stocks go down, receipts go down. You're at 115% on the big three. Nothing else you can cut matters. You can cut parks and services. Nobody gives a crap. Department of Labor, education, all this stuff doesn't matter. The only things you can cut to make a difference, to try to shrink
it doesn't matter in terms of you're not going to save that much money for the problem.
You're not going to save.
You're going to get a lot of crying.
Yeah, you're exactly. And you just can't cut that. So you've got to cut entitlements, defense, or interest. All right. Well, the only way to cut interest is by cutting rates. So we're going to reinstate this. So let's take that one away. Now you're left with entitlements or defense. Okay. We're going to cut entitlements in an election year? There's no freaking way. Now, so are we going to cut defense in the middle of a rising Cold War? There's no freaking way. So what are our release valves? Our release valves, our rates are going to keep going up, or the Fed's going to print the difference. The Fed's going to implement more QE and yield curve control, which now we overlay that on all these other bullish overlays for commodities. It's like, oh my God. Number one, as if you're looking out 10 years, how can you not have a bigger allocation to commodities and industrials, gold, et cetera? And what are you doing buying the 10-year treasury at 4.3 when the short term's at 5.3? Like, stop. Like, it's blood sport. It makes no sense as an investor. The other thing I would say that most people, when I lay out this second part, I see their body language just drop because they realize how trapped the Fed is. And that is, if we want, I frequently hear, we just need to run a balanced budget. We just need to run a balanced budget. Let's just cut to run or close to, or not even close. Let's just cut deficits back to 2% of GDP, which is kind of where they should be, given where unemployment is, given where the economy is, what GDP is doing, where it was under Volcker. Okay, let's do that. I just said before, trailing 12-month deficits are at 8.4% of GDP. So we need to cut 6.4 points out of government spending, out of the fiscal side, right now, to get to 2. 8.4 minus 6.4 is 2% of GDP. 6.4% of GDP cut right now would drop GDP by 6.4% right now. By way of comparison, when Lehman blew up, full year GDP was down 3, and that was enough to nearly take down the whole system. In COVID, when we shut the whole friggin' economy down, full year GDP, I think, fell 6 annually. Maybe at the worst, it was down 8 or 12 in one quarter. But the point here is that, and this is what people don't realize, is it's too late. Unless you get an energy productivity miracle, or you have a time machine. You know, we get into an 84 DeLorean with a flux capacitor. We go back to 1989 and we do, go to our politicians and do the biff like, hey, stupid, hello. Be an adult. There's no fix for this. And we know this. This isn't speculation on my part, because we can go back to 2014 with Obamacare, which the Supreme Court says was a tax increase. It was functionally a tax increase. The Supreme Court said it was a tax increase. What did it do? You go back to the Wall Street Journal, December 2014. Obamacare will help reduce the deficit by pushing the government's biggest expenditure, a bigger share of that, onto U.S. consumers. It was a tax increase. You raise taxes on small and mid-sized businesses, increase premiums to reduce the government's healthcare expenditure. Okay, great. That's what we should do. Right, Luke? Oh, wait. Fast forward 15 months in 2016, guess what the deficit did as a percent of GDP? It rose. The U.S. implemented an effective tax increase to reduce the deficit, and within 15 months, it increased the deficit, because guess what happened when people had to pay for more of their health care to take it off the government's plate? They didn't buy as many cars. They didn't go out to eat as much. The dollar went up, and that weighed up because we were crowding out global dollar markets. So what I'm saying is we know that if they tried to cut, forget about 6.4, the system would collapse. Even if they cut 3, which the system would probably still collapse. Within 15 months, the deficit's not going to be 5.4. The deficit's from 8.4. The deficit's going to go to 10, because you're actually going to be reducing current incomes, and people don't understand the dynamic that it's a little bit, and I don't want to make light of being sick, but if you wait too long to get treated for certain diseases, they don't say, well, it's okay. They say, here's some opiates, and we're going to make you comfortable. We're going to put you in palliative care, and this is all we can do for you. And so the palliative care in this case is more QE or yield curve control or miracle. And miracle is productivity, massive productivity boom from any number of different things, technological, demographic, et cetera. We can talk about that. But I find that it's just very poorly understood that they're this cornered.
Now, we behind me, we run a conversation on Bloomberg with institutional investors in about 20 countries, and it's 99% buy side. So it's hedge funds, mutual funds, pension funds. And we're constantly talking about these things and different trading themes. One part of the conversation that's been talked about in recent months is on the fiscal side. A lot of this fiscal, the Democrats, quite brilliantly, they've approved a lot of fiscal because they knew the Republicans would potentially take the House and stop them. And now they're slow walking a lot of this fiscal in from spending that from the debate is a debate, but from all the spending that's been approved in recent years, especially in the last like 18 months, there's a certain amount of it that hasn't really gotten into the economy yet. Whereas it's not really, like, say you have shovel-ready projects in environmental. Take the U.S. power grid, for example. You take Biden's infrastructure plan. They want to do Build Back Better. The U.S. power grid is like, in some parts, 30, 40, 50 years old, some parts 20 years old. We're going to put all these electric vehicles on it. There's 200,000 new electric vehicles in Texas, and the grid is buckled, literally almost broken down 3 times since, I think 4 times in the last recent years. The estimates around this spending are upwards to fix the power grid that you're going to put all these electric vehicles on is anywhere between 5 and 6 trillion. Now, some of that's already in the hopper. But what are the investments? I'm thinking, looking out the next 10 years, I'm thinking about aluminum, copper, because this capital is going to go to work. We have to fix the grid, but some portion of the fiscal has been implemented, some portion has not. Have you given any thought to what's been implemented, what isn't, and why that's creating more? Because we technically potentially should have gone into recession based on a lot of indicators out there, leading economic indicators, ISM. Raoul Powell's done a good job looking at some of these things, but we haven't because of this drag out fiscal. Have you looked into that at all, and how that's playing out in markets?
I have. We've done a lot of writing in the last 4 months in particular about fiscal dominance, that basically the Fed's not in control anymore. The U.S. government is. It's interesting when you go back, the weakest economy that we've had was in 2Q and 3Q last year, when U.S. fiscal outlays were declining year over year. Other than that, the rates haven't impacted overall headline GDP as much as many people, myself included. Initially, I had 28 years of experience teaching me the wrong lesson, that the Fed is dominant and the Fed is going to drive a recession. And there have been several people who have been very influential in my thinking over the last year, really. The first was Warren Mosler, who's a monetary system expert, is known for MMT, obviously. MMT is really an explanation of flows. It's a very politically charged word, right? People think of, hey, print money and give it away.
Modern monetary theory is this.
Correct. But it's really much more of just a description of how private public sector flows of money work in a fiat system. And Mosler earlier this year was saying the Fed has it backwards. No one alive in trading has ever been alive in trading when U.S. debt to GDP was 120%, when U.S. deficits were 6-7% at the start of a tightening cycle. Now they're higher.
Yeah, so right now the U.S. deficit's been anywhere between 6 to 8% of GDP. I just want to make that. So,
yep.
Whereas the last 50 years, it's averaged around 2 to 3%.
Yeah, exactly. And then Mosler's initial point was the interest is the Fed's adding to demand because the debt's so high, and this has never happened before. And then Charles Calamiris put out a white paper with the St. Louis Fed back in early June. I read it, and my jaw dropped, because it talks about this fiscal dominance in much more specific terms. And when I started looking at it through that lens, what I come to conclude is the U.S. went into fiscal dominance in September 2019 in the repo rate spike. Because for all the noise about what caused the repo rate spike, yes, there was regulatory, yes, the bottom line was there was too much supply of treasury paper and there was not enough private sector balance sheet. That's the very essence of fiscal dominance. And once that happened, how did the Fed respond? we saw rates in repo went from 2 to 8 virtually overnight. And within 48 hours, the Fed said, no, we're printing money. We're going to bring that rate back down. At that point, the U.S. went into fiscal dominance. Obviously, we had COVID. We had the fiscal impact that you highlighted. Fast forward, again, we see the banks have been getting stuffed with treasuries, encouraged to buy them for regulatory reasons, et cetera. There's de facto QE, particularly when the SLR, supplementary leverage ratio, was exempted from March of 20 through April of 21. Again, the Fed starts raising rates and the banks get upside down. If the Fed really wanted to permanently stop inflation and permanently slow the economy, as in 2019, they should have just stood aside. But they didn't. They came in with BTFP. They quickly sort of guaranteed, kind of, don't want to be explicit, unsecured depositors. Again, fiscal dominance. And so I think we are in, when to answer the question of how am I thinking about the fiscal impulse from a top-down perspective, most market participants are still playing by the old rules of the game of the last 40 years, which is the Fed is dominant, watch rates, watch the private sector. But there's new rules: 120% debt to GDP, 8% of GDP deficits, foreign central banks not buying any treasuries on net still. Banks now full with treasuries. The game has changed. We are fully in fiscal dominance. And so it gets to a very different outcome, which is the biggest driver for marginal GDP is the federal government and deficits, number one. Number two, Fed rate hikes are functionally acting as stimmies, just like the stimmies we all got in COVID, right? So in COVID, let's take a step back and see things for what they are. In COVID, we ran a big deficit. The federal government ran a big deficit by handing checks to people, and the Fed bought those, basically monetized that by doing QE. And global supply chains were shut down or disrupted by COVID. So you have a bunch of new money pumped in to the system. As supply chains to provide goods against that pumping in of money was curtailed, and we got inflation on a lag. Very high inflation, highest in 40 years. Okay, let's fast forward to now and the Fed rate hikes. We were talking about before at 5%. If they just stay here, we're going to have $1.3 trillion in interest. $1.3 trillion. That's just a stimmy. It doesn't go to everybody. It goes to wealthy asset holders. And so it's a little bit more sterilized.
A lot of those asset holders are overseas. Like that money actually leaves the country to some extent because people that own treasuries around the world get our interest. It doesn't really come back to us. It does, but it doesn't.
It does, yeah, exactly. And there's some whole bunch of perverse political impacts, right? So basically, we're helping China fund their military to put up a defense against us by raising rates because they still own $800 billion. But that's, again, separate discussion. So you have $1.3 trillion in interest stimmies, increased fiscal impulse based on what the Biden economics are doing, Bidenomics, inflation, et cetera. Again, it's not direct to consumer, but it's defense and it's inflation reduction, it's reshoring, it's these environmental imperatives. And what's the Fed's rate hikes doing to the private sector? They're curtailing. It's not as drastic as COVID, but we can see it in the ISM, we can see it in production indices, we can see it in all these. The private sector is shrinking. The lending, and it's going to shrink more from the lending survey, the private lending surveys done by the Fed. There's not much functional difference between what we did in COVID, stimmies, curtail production, add 9 months, holy crap, we have 8% CPI, to $1.3 trillion in interest stimmies, curtail production a little less, and yet consensus is, oh, don't worry, inflation's going to stay low. Ain't going to stay low. You're pumping money into the system via fiscal, paradoxically via rate hikes. And so most market participants are still playing the old game of, hey, the Fed's dominant. Fed's not dominant. Fiscal's dominant now.
Everybody's long the last decade's portfolio. Everybody's long. Everybody's still long. This is, to me, we are going to see the greatest migration of assets, of wealth in the history of humanity in the next 3-4 years.
Absolutely.
Now, if you think about waste. No, you brought up some of the problems. Here's what I hear. So one of the people, one of the investors in our book, I think one of the most brilliant guys that I've met on Wall Street over the years. Mark Cheval was at Moore Capital for years at Goldman Sachs. Now runs the family office. But Mark's point in my book, in our conversations, I can say this with permission, is financial repression. And let's just describe what that is. It's when you keep the rate of interest below inflation. And so I'm thinking about I want investors listening to us right now to see what the next decade is going to look like, because it's not just about, you're right, it's about yield curve control and that type of thing. But aren't they going to have to force the entire U.S. pension system to own a greater percentage of, say, treasuries? Or aren't they going to have to force the banks through regulation to own even more treasuries? So what in terms of financial repression, and I've read some of the white papers out there, and there's some interesting white papers that are coming out. We're looking at like really, I don't want to say China-like state demands, but in order to get through this, there has to be some type of pressure on the private sector to own treasuries, because the Fed can't do it all.
Yeah, so I'm going to have 3 points on this. I'm going to try to remember them all here. The first is, yes, absolutely. And you're seeing some of these white papers. So Calamiris, for example, his white paper on the U.S. being in fiscal dominance highlights that the rate of inflation to get out of our current debt position, if you don't do any financial repression, given current levels of deficits and given current levels of basically the status quo system where it's set up, you're going to need 40% CPI inflation. I read that paper and I've been thinking inflation will be way higher. I think my jaw dropped. He notes that if you financially repress the banks, what you do is you increase reserve requirements. So exactly, hey, you have to own way more treasuries against your capital base. And you're starting to already hear that, right? Every time you hear the Fed come out and say, oh, the banks are a little unsafe, banks are fine. The banks are a little unsafe. We need to increase capital requirements 20%. We've seen a number of these. That is them going, oh shit, we have a fiscal problem, and they're setting the stage for this financial repression. So Calamiris noted that if you significantly raise reserve requirements, so they got to hold a lot more treasuries against their asset base, number one, and then number two, slash the reserve rate back to zero, right? So right now the Fed is paying these banks to 5.3, 5.2, I don't know what the number is, percent against their excess reserves to keep those reserves in that $1 trillion box that you referred to, right? That's the reason that $1 trillion box is still there now that they've earned their way out of it, is because they're getting paid to keep it there. The Fed's basically bribing them not to lend the $1 trillion in that $1 trillion box. So what the Fed could do is say that $1 trillion in that $1 trillion box, now you get zero. Now, normally the Fed would go, or those banks will say, well, fine, we're going to take it out and we're going to lend it across the economy, GDP up, inflation up. Okay. What Calamiris says, one step to doing this is you say, hey, you've got to hold that whole $1 trillion as capital, and we're not paying you for it anymore. And if you do that, Calamiris said, it kills the banks, kills their profitability, but it gets inflation needed to get out of this mess down to like 16%. So again, yes.
If you go all in with the financial repression tools, you get inflation down to 16%.
You kill your banks. And again, this ties back to my point about like people don't understand how cornered they already are. If you kill your banking system by stuffing them full of treasuries and cutting the reserve rate to zero, you get inflation down to 16% in his white paper. And you go, oh my God. So, okay, that gets us to the second point. The dollar as global reserve currency, fundamental underpinning is open and free flows of capital. And this is a side of it that I don't often hear. Yes, financial repression, I think some version of it will absolutely happen. The problem is you can only do a little bit particularly with foreigners. You can do whatever you want to your own people. Problem there is the boomers have all the money and they're net sellers. Like there isn't a rate that you can raise rates to convince a 70-year-old boomer to change their time preference, right? Like they're saying, I got 5 good years left, maybe 10. I don't give a shit if the Fed pays me 20. I want my money and I want to go to Italy and I want to buy the fast car that I always wanted as a kid and I want the third house and I want the U.S. government's rate sensitivity is way lower than the Fed, than these boomers. And so the
the boomers, I think, have 78 trillion of wealth, 78 trillion of wealth versus the millennials only like maybe 6 trillion, 6.5. Right. And the oldest boomer now is 78. And when Lehman went down, the oldest boomer was obviously kind of like in the early 60s. 63.
It's a totally different ballgame.
Yeah, but aren't those boomers at 78 more inclined to own fixed income now than they were after Lehman failed? So that's one possible thing that would help the equation.
I think at some level, once you get immobile and sick, yes. But, the average 78-year-old boomer is the healthiest 78-year-old in the history of mankind. And again, we just locked them down for 3 years and we told them they're going to die way sooner than they think. And so there's just a YOLO trait amongst boomers. I mean, go to any restaurant in any city in America and look around. You'll find at least 2/3 of the people are boomers. They go out to eat every night. They go on lots of vacation. And God bless them. Like, they've lived great lives. They're full life. But my point for this part of the discussion is they're sellers. They're not buyers, not net still. And maybe in another 10 years, maybe they're buyers. Now, how can you get them to be buyers? Well, I don't want this to happen, but if you set the law so that when they die, their kids are locked up, right? Now you can financially repress their kids. So I get that 78 trillion, it passes to their kids.
What do you mean by locked up?
Yeah, you lock that up.
In terms of, what do you mean by kids locked up?
Their wealth, right? So the boomer dies, his estate passes to his 45, 50-year-old kid.
Yep.
And the government says, sorry, we're going to take 70% of that. Or you can't touch 70% of anything a boomer hands you in a death benefit has to go into treasuries, into 30-year treasuries.
No more, or no more step up in cost basis, right? Because
there's a lot of different, exactly. There's a lot of different ways you can do that. Now, that brings me to my third point. So you can do that with the boomers, but again, you can't do that too much with international because that has dollar reserve currency status, right? We're already talking about this de-dollarization of commodities because out of necessity. But if you start telling foreigners, hey, we're going to pay you 3 when inflation's 16, you'll see what we've been seeing, which is they're going to give you the middle finger and they're going to sell treasuries and they're going to buy gold. And that's exactly what central banks have been doing for 10 years because I think they've seen the writing on the wall. So that's not just a Fed, that's a treasury issue, right? Because the dollar typically is the purview of the treasury. Anyway, okay, third point. And this is the big one that people tend to miss, which is the last 40 years have basically been about financially repressing foreign U.S. creditors, right? On average, for the last 20 years, certainly since Lehman, the United States debt has grown by 8% per year CAGR, compound annual growth rate. The rate on that debt has rarely been above 4 and rarely been above 3. That's like the greatest deal on the planet. Like I will borrow $100 trillion from anybody that will let me borrow 8% more than that every year at a 2%, 3%, 4% rate. It's stupid. I will do it for the rest of my life. And that's been what we've done for the last 15 years. And now the rest of the world. So basically, that is akin to your kid having a drug problem and stealing from the neighbors, going in every night, breaking into the neighbor's house, stealing some jewelry, hawking it. You're like, oh, my kid's doing great. Doesn't affect me at all. Once foreign central banks stop growing holdings of treasuries, once foreigners, in particular the central bank level, stop growing holdings of treasuries, the U.S. has to fund more of its own deficits. And if you financially repress your own people, it's like your kid's stealing from you to have a drug habit. You end up poor. In the first scenario, your net worth, your net income isn't hit at all. You don't notice. In the second situation, where your kid is stealing, your wife's wedding band and selling it for drugs, and then raiding your bank account, so that's financial repression. So it is very much a decline in real living standards that, oh, by the way, suggests bullishness for a commodity portfolio over the next 10 years. So that's, yes, they can financially repress the planning. There are some dollar implications in terms of reserve currency status. You can't do too much to the foreigners, and that's something that is almost always left out of these discussions of financial repression. And for a very simple reason, no one wants to talk about it because there's no easy answer. And number three, so repressing your own people, it's like, your kid's stealing from you to fund a drug habit as opposed to stealing from the neighbors, when we were repressing foreigners by the way we've run the system over the last 15, 20, 40 years.
It all goes back to Tocqueville and Tytler. You go back to the late 1700s, and there were these predictions of the cycle of democracy, because no democracy's ever lasted more than 275, 250 years. And, you really, with all democracies, there's like a cycle where you start off in apathy, which you think about, you start off in bondage is actually the first state. Bondage, you think about the United States under the UK, right? United 1775, 6, Tea Party, that's bondage essentially, right? And then you've got spiritual faith. Then you've got entrepreneurship, abundance, 1950s, 1960s. And then you have the apathy. Then you have a little bit of dependence, despair, back to bondage again. And you could see this cycle in the world in, say, Argentina. You can see it in the world in, say, Venezuela. You could see this cycle forming, and it's been out there. Other parts of the world, United Kingdom, I wouldn't say it's not a pure democracy. It's a monarchy turned into a democracy to some extent. It's not a real republic. But if you look around the world in that cycle, and if you look at the United States, the argument for the dollar is, we're the cleanest of all the dirty shirts, and that's essentially what's enabled the politicians to grossly be so irresponsible, right? Because we've always been the cleanest of all the dirty shirts. And now we look around the world, and there are a lot of dirty shirts out there. And so, how do you quantify the dirty shirts versus the politicians on Capitol Hill that have been so, really recklessly irresponsible?
My friend Brett Johnson always says, well, everyone does this in all these capitals. He's 100% right. The dynamic that I think is grossly underappreciated is that in this whole discussion is the net international investment position, which in the United States from 1976 to 2012, the U.S. net international investment position was positive 10% of GDP to negative 10% of GDP. Basically a linear decline from positive 10 to negative 10 from 76 to 12. The way the world worked with the dollar and dollar diplomacy for that almost 40 years was Fed hikes rates, dollar rises, foreigners burn down FX reserves, their net international investment position effectively to defend their currency. They run out of those dollar reserves because they don't own that much, right? They only own, negative 0 to negative 10%, of U.S. assets on net, right? Even less in the 70s when U.S. net international investment position was positive. They burn down those reserves. Once they run out of those reserves, they have to devalue their currencies. Their currencies fall, their economies fall. Then there's a crisis. The Fed responds to that crisis, drops rates, and the U.S. sort of goes in and buys up foreign assets on the cheap, and we restart the whole cycle of releveraging again. And that's kind of how it worked. And what most of the discussion around the dollar that I see and have seen for years fails to grasp is that the United States net international investment position since 2018 has been negative 50, negative 60, negative 70 as of 2021. It's bounced back a little bit, percent of GDP. These foreigners now own on a net basis $18 trillion of U.S. assets. And so in the past, when they would burn down those FX reserves, they didn't have enough dollar assets to really hurt us while they were going into crisis, especially because back then we had enough short so much of our industrial base that we weren't so critically marginally dependent on asset prices rising for tax receipts, for consumer spending growth, for GDP growth, as we are now. And that's really only evolved since 2000, based on policy choices we've made. So now you've got foreigners, Fed raises rates, dollar goes up, foreigners start selling, and they keep selling, and they keep selling, and they keep selling, and they just sell more and more. And now they have so much in savings in the net international investment piggy bank, it's no longer them that break first. It's
no longer what?
It's no longer these emerging markets that run out of reserves and break first. It's now the U.S. banking system that breaks first. It's now the treasury market that goes dysfunctional first. It's now U.S. stocks that fall, so U.S. tax receipts fall, so U.S. deficits are blowing out in a good economy, in a 3% unemployment economy, as we are seeing. And that is the dynamic of this dollar discussion that is poorly understood, which is these foreigners own so much of our assets because basically over the last 15 years, we didn't have a recovery as much as we hawked our assets to China and others to buy trinkets. It was petty wise, pound foolish. And so, yes, the dollar is the cleanest dirty shirt, but not for the reason they think, which is to say the more the dollar goes up, the more they're going to sell these assets, and the more they're going to, and
the whole dollar wrecking ball thing, the last 20 years, like 25 years ago, the dollar moved up, say 8 handles. So say from 90 to 98. Well, what's happening is the negative feedback loop back to the United States, to your point, seems to be much greater. And I think what's fascinating about like the 2016 election, the dollar strengthened so much because the Fed was focusing on a potential exit, potential, unwinding of the program or raising rates or, the threatening QT. And so you have this dollar strength in 2016 and all this negative feedback loop back to the United States and ended up impacting the 2016 election. And now we have the dollar strength again. Is this adding to that dollar wrecking ball dynamic that you're talking about?
And that's the paradox is, yes, it does, because ultimately it leads to more dollar strength, right? Because now foreigners are dumping treasuries to defend their currencies. Yields are going up. You can see the breakdown in correlations. Historically, 14, 15, yuan down, treasury yields down. It was a very deflationary dynamic. 2018 to 2020, yuan down, treasury yields down. Now, yuan down, treasury yields up. Even though, set aside 2022, say it was all inflation. We've been very disinflationary in 23. Yuan down, treasury yields up. We saw it last year with the yen. When oil rises, oil price increases put Japan into a current account deficit position, right? They need to sell their piggy bank. What do? Washington, give us our dollars back. Japan has a positive 60% of GDP. Net international investment position. What does that mean? That means they have 60% of their GDP in assets, most of it in dollars. So when they get upside down, when the dollar wrecking ball starts to hit them, they just call and say, sell treasuries, sell treasuries, sell treasuries. Well, that's fine in 2000 when Southeast Asia was doing it. The United States was running a surplus. We didn't need anybody to finance our deficit. Now we're running an 8.5% trailing 12-month deficit. So immediately it feeds back into the treasury market. Oh, rates go up. Well, what happens when rates go up? Oh, the U.S. banking system, we were just stuffed like, foie gras full of treasuries. Now they're upside down. And this is the treasury wrecking ball dynamic that I think is poorly. So in the short run, yes, dollar up, dollar up, dollar up. Yay, we're winning. No, you're not. You're losing. The dollar's going up and you're losing. If they want the dollar super spike to continue, what will eventually be required is for the Fed to stand aside as the 10-year Treasury does what repo did. Because that's what's going to happen. Because the supply-demand at foreigners own $7.5 trillion in treasuries. That's this net international investment position. They have the option of saying, hey, got $7.5 trillion to go, want to be done by the end of the day. We got to defend our currency against the dollar. Obviously, it's an extreme example. It's not going to happen. And people say, Well, the Fed will just print the money to buy it. I said, exactly. And the dollar ain't going to friggin' go up when they do that. We know that. We've seen it in 2019. We saw it in 2020. We saw it in 2021. And so the dollar wrecking ball is a strategy. It's generals fighting the last war. Can you make Dixie go up? Yes, congratulations. The dollar wrecking ball was supposed to break China before it broke U.S. banks. It didn't. It was supposed to break Russia before the treasury market started dysfunctioning again. It didn't. It was supposed to break China before it broke the UK gilt market. It didn't. And that's the reason why the order is reversed this time, why it's hitting us first, is this net international investment position. And into the balance sheet constraints, into the deficit sizes. If you run the wrecking ball, you turn foreigners into sellers, $7.5 trillion to go, want to be done by the end of the day. And the Fed's going, I got $1.2 trillion to do over the course of the year, want to be done, with QT, under $1 billion a month. And Treasury's going, hey, I got $2.2 trillion to go. And the banks are going, oh shit, we're upside down. I got to sell some because my CRE credit losses are building. You told me to buy this stuff as high quality liquid assets to sell in a crisis. Now I'm a seller too. What do I do? So now the banks are a seller and the boomers are like, hey, I want to go to friggin' Italy and drink wine because you locked me down for 3 years and I got this treasury portfolio. I'm a seller. Who the F is buying? There's no buyer, not at these rates. There's no buyer. And this is the part, like the dollar wrecking ball, like, can you make, will the dollar go up on that? Yeah, the dollar will go to friggin' infinity. Congratulations. If you stand aside and let the U.S. default on treasuries, literally, we're not paying any of it, the dollar will be at 1,000 that day on the Dixie. Congratulations. Where do you go? You won. They're fighting the last war. It is hilarious to me to watch people cheer this going up. And oh, by the way, as that happens, like stocks ain't going to be going up, it'll be yields up, dollar up, U.S. defaults. And oh yeah, so will everybody else. Great. Who cares? Like, it's like, well, my neighbor died and I died of a gunshot when he died of cancer. So I was quicker for me. Like, you're both dead. Doesn't frickin' matter. Europe will be in trouble. Japan will be in trouble. China will be in trouble. And you know what the game will turn into is, all right, everybody take your gold and put it on the table. Call. Who really has gold? Because the oil sellers are going to be going like, I'm not selling for this confetti paper. I want to be paying gold tomorrow. That's what Saudi says.
Yeah, and it's gold. It's it's a whole portfolio of hard assets, and that might be the portfolio for that. It's the aluminum and copper to work on the U.S. power grid. It's platinum and potentially palladium for the hydrogen. This green hydrogen dynamic around helping to create that green meadow that we want to create. And so there's all of these social goals around decarbonization, and then there's this financial dynamic that we've laid out on this call today, on this conversation. And so it just all points toward a portfolio of hard assets and companies that hold these assets, because companies have these assets in reserves inside.
Absolutely.
And so you can get long hard assets for companies that have them in reserves. Yeah. Anything in closing you want to wrap up with? But I think it was a spectacular job you did, and I really appreciate that I really appreciate that 20,000 foot view, which nobody really bothers. Everybody's microscopic and I think now we really need to have that Tocqueville-Tytler, that 20, because at the end of the day, Tocqueville and Tytler, what they used to say is a democracy can only last until the people realize they can vote themselves largesse from the public treasury, right? That's why democracies don't last, because each generation that goes on is a little softer, not as stronger. They're voting themselves largesse, and eventually the spending overwhelms the receipts, the tax receipts, and that's kind of where we're headed.
That's exactly it. And it's going to force, the dollar wrecking ball dynamic we were just talking about. It brings forward, yield curve control is coming. And every tick up in the dollar brings that forward. I don't know if it brings it forward a week or a month or a quarter, but it brings it forward. And that's where this goes. And that's ultimately where I think the financial repression will be in the treasury market, in the Western sovereign bond market more broadly. And I think what we've been watching over the last 15 years has been those investors with the luxury of not having to mark a portfolio to market on a monthly basis or on a quarterly basis or on a yearly basis, making that move. So when you see global central banks stop buying treasuries on net in 2014 and moving into, in particular, what Zoltan's talked about, FX, storing more of your FX reserves de facto in commodities, right? So historically, China used to sell out to us. We would give them dollars. They would take the dollars. They'd buy treasuries. And then those treasuries were the piggy bank to buy commodities in the future, all priced in dollars. And what we've seen is a move by China to gain greater ability to buy commodities in yuan, but then also cutting out the middleman of the treasury market. They're not buying treasuries, and they haven't. They've been selling. And while people say they are in a dollar shortage, the last year or in the last 6 months, they've signed 2 27-year-long LNG deals with Qatar. That's just buying gas in the ground, and that's the whole trade. China has the luxury of not needing to mark their book to market monthly, quarterly. All they're doing is saying, I want to be long. I think LNG bought direct under the ground is going to be greater value to me than buying 27-year treasuries. And then when I need the gas, selling the treasuries and buying the gas. What they're saying is treasuries are going to collapse against gas. They're going to collapse against oil. They're going to collapse against gold. They're going to collapse against the stuff we need to live and run our economy. And I think that is the trade. And not even the trade. I think that's that secular 3, 4, 10-year investment that you let off by talking about it. So I think it's important to see things for what they are in terms of how that system is evolving, driven by the factors of financial repression and over-indebtedness and geology that we talked about before.
Well, thank you, Luke. And it was a pleasure to be back on Real Vision. I haven't been on in a while. Our book is When Markets Speak. I hope, Luke, I can count on you for a blurb because it'll be out in the next couple of quarters. And it kind of goes into the heart of this conversation. It looks at the next portfolio for the next decade, the next 20 years. And it's been great to share this hour and 20 minutes with you, Luke. Thank you so much.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.